Residential sales comparison and income approaches. Chapter 16, 2 to 4 unit residential income property appraisal. Page 23, check your understanding. This quiz has a total of 3 questions. There will be 1 question per page. You must achieve 66% to pass this quiz. Start quiz. Number 1. In actual practice, the operating income statement form 216 is typically prepared by A, the underwriter, B, Fannie Mae, C, the listing real estate agent, or D, the appraiser. I'm going to go A, the underwriter. I'm 80% sure on that one. Number 2, in Form 216, the income to be projected for the next blank months. A, 6, B, 12, C, 18, or D, 24. I don't remember this one, but I'm just going to say B, 12 months. And lastly, number 3, lenders use blank income when underwriting loans for 2 to 4 unit residential properties. A, operating, B, potential gross, C, effective gross, or D, taxable. I'm going to go C, effective gross. I'm like 10% sure on that. Assessment completed, finish. You failed, you got a 33%. So remember, number 1, in actual practice, the operating income statement form 216 is typically prepared by, you said, the underwriter. That was incorrect. The actual answer is the appraiser. God damn it. The instructions on the form state that Form 216 should be prepared by the applicant, lender's underwriter, and the appraiser. So I guess you were kind of right. I remember that. In actual appraisal practice, the appraiser is usually the party who completes this form. Motherfucker. Number 2. In Form 216, the income and expenses have to be projected for the next blank months. You said 12 months, and that is correct. Number 3, lenders use blank income when underwriting loans for 2 to 4 unit residential properties. You said effective gross. That's incorrect. The correct answer was operating income. Lenders use operating income when underwriting loans for 2 to 4 unit residential properties. Try again. Start quiz. Number 1, lenders use blank income when underwriting loans for 2 to 4 unit residential properties. A, operating, B, potential gross, C, effective gross, or D, taxable. I'm going to go operating income when they're underwriting loans for 2 to 4 unit residential properties. Number 2, in Form 216, the income and expenses have to be projected for the next blank months. A, 6, B, 12, C, 18, or D, 24. I'm going to go B, 12 months for Form 216. Number 3, in actual practice, the operating income statement, Form 216, is typically prepared by A, the underwriter, B, Fannie Mae, C, the listing real estate agent, or D, the appraiser. I'm going to go D, the appraiser. Assessment completed, finish. You got 100%. Continue.
Residential sales comparison and income approaches. Documents. steps necessary in developing an estimate of net operating income. The rest of the chapter followed step by step the requirements of completing the operating income statement, Fannie Mae Form 216. Even though this underwriting form is no longer required by Fannie Mae, it is still required by many lending institutions when reporting the appraisal of a 2 to 4 unit residential property on a 1025 form. First, we will take a chapter-ending quiz, and then the next chapter will be a case study to illustrate how to fill out a Form 216. Click here if you would like to open this chapter as a PDF, which you can then print or save to your device. Chapter 16. End of page. Chapter start. 92%.
Residential sales comparison and income approaches. Chapter 16, 2 to 4 unit residential income property appraisal. Page 25, Chapter 16 ending quiz. This quiz has a total of 7 questions. There will be 1 question per page. You must achieve 80% to pass this quiz. Start quiz. Number 1. The anticipated income from all operations of the real estate after an allowance is made for vacancy and collection losses and an addition is made for any other income is the definition of A, gross income, B, potential gross income, C, effective gross income, or D, net operating income. I'm going to go B, potential gross income. Not 100% on that one. I know I've done it before, though. Number 2. Which would not be considered a management expense? A, plumbing repairs. B, collecting rent. C, advertising. Or D, preparing leases. I'm going to go B, collecting rent. Number 3, which type of income considers vacancies? A, potential gross income. B, effective gross income. C, both potential gross income and effective gross income. Or D, neither potential gross income nor effective gross income. This was kind of hard because, you could say potential gross income too because, it's like if the home, whatever, the unit has all the units rented out, then you would still consider vacancy. So I guess I'm just going to go C, both potential gross and effective gross income. Number 4, potential gross income minus vacancies and credit loss equals blank. A, effective gross income. B, total operating expenses. C, net operating income. Or D, expense ratio. I'm going to go A, effective gross income, EGI. Number 5, a 4-unit property has 2 units rented at $900 per month and 2 units rented at $1,200 per month. The vacancy and collection loss rate is 6%. Total operating expenses are $21,525. What is the NOI? A, $25,851. B, $47,376. C, $22,369. Or D, $24,087. The answer is A, 25,851. All right, that took a while. So what I did was I took the total years collections from all 4 units, added them together, figured out what 6% of that total was, which was $3,024. I minus that from that total, which kicked me out, I believe, $47,376. And then ultimately, I took the operating expenses of $21,525 and minused it from that, which left me an NOI of $25,851. Because NOI is on the bottom. Number 6, the sum of all fixed and variable operating expenses and the replacement allowance cited in the appraiser's operating expense estimate is the definition of replacement reserves. B, A is replacement reserves. B is vacancy and collection loss. C is total operating expenses. And D is operating expenses. Sure, I'm just going to go through operating expenses. Number 7, potential gross income minus blank equals effective gross income. A, operating expenses. B, vacancy and credit loss. C, expense ratio. Or D, replacement allowance. I'm going to go vacancy and credit loss. B. Assessment completed, finish. God damn it, you failed. 57.1%. All right, so number 1, the anticipated income from all operations of the real estate after an allowance is made for vacancy and collection losses and an addition is made for any other income is the definition of, you said potential gross income, that's incorrect, it's effective gross income. That is effective gross income. It is what's left after you subtract an allowance for collection losses from the potential gross income. I knew that, but it's just the way it's worded, it doesn't sound right. Number 2, which would not be considered a management expense? You said collecting rent. That's incorrect. The correct answer was plumbing repairs. Plumbing repairs is part of repairs and maintenance items, not a management expense. Number 3, which type of income considers vacancies? You said both potential gross income and effective gross income. That's incorrect. The correct answer is effective gross income. Effective gross income is what is left after vacancies are deducted from potential gross income. I know that. It's just the fucking way it's worded, man. I mean, you still have to kind of consider it in potential gross income, because if you added it, you know, that means potential. So I honestly kind of think they're kind of wrong. I know what effective gross income is. Number 4, potential gross income minus vacancy and credit loss. You said is effective gross income. That is correct. Duh, I already know what that fucking effective gross income is, man. 5, a 4-unit property has 2 units rented at $900 per month and 2 units rented at $1,200 per month. The vacancy and collection loss rate is 6%. Total operating expenses are $21,525. What is the NOI? You said A, $25,851. That was correct. Good job. Number 6, the sum of all fixed and variable operating expenses and the replacement allowance cited in the appraiser's operating expense estimate is the definition of. You said total operating expenses. That is correct. And lastly, number 7, potential gross income minus equals effective gross income. You said vacancy and credit loss. That is correct. Try again. Number 1, which type of income considers vacancies? A, potential gross income. B, effective gross income. C, potential gross income and effective gross income. Or D, neither potential gross income nor effective gross income. Let's go with what they said, effective gross income. Number 2, total income from a property before deducting any expenses, customarily stated on an annual basis, is the definition of A, gross income, B, cash flow, C, after tax income, or D, net operating income. I'm going to go A, gross income. Number 3, a 4-unit property has 2 units rented at $900 per month and 2 units rented at $1,200 per month. The vacancy and collection loss rate is 6%. The total operating expenses are $21,525. What is the potential gross income? A, $47,376. B, $50,000 and $400. C, $55,200. Or D, $48,000. I'm going to go B, $50,400 for potential gross income. The sum of all fixed and variable operating expenses and the replacement allowance cited in the appraiser's operating expense estimate is the definition of A, replacement reserves, B, vacancy and credit loss, C, total operating expenses, or D, operational expenses? I'm going to go C, total operating expenses. Number 5, Fannie Mae Form 216 should be used when appraising A, single unit properties only, B, apartments up to 8 units, C, small commercial properties, or D, 2 to 4 unit residential properties plus 1 unit investment properties. Why did I have to say that? I'm still going to go D, 2 to 4 unit residential properties. Number 6, a 4 unit property has 2 units rented at $900 per month and 2 units rented at $1,200 per month. The vacancy and collection loss rate is 6%. Total operating expenses are $21,525. What is the EGI? A, $50,400. B, $44,896. C, $25,851. Or D, $47,376. I'm going to go D, $47,376. Number 7, which would not be classified as other income? A, parking space rental. B, rental income. C, vending machine income. Or D, coin operated washers and dryers. I'm going to go B, rental income. It doesn't fit along that kind of those incomes. Assessment completed, finish. You passed, you got 100%. So just remember all the things we just said. Continue.
Help. Documents. Email instructor. CH17, Small Residential Income Property Appraisal Report. EG1 Overview of Chapter 17. Notes. Leave a comment. Overview of Chapter 17. In this chapter, we will study the Small Residential Income Property Appraisal Report, SRIPAR, Fannie Mae Form 1025. We will tie together both halves of this course and look at how to complete the sales comparison approach and the income approach when appraising 2 to 4 residential units. First, we will examine the sales comparison approach section of the 1025 form and demonstrate how to use the unit indicators that are part of the sales grid. Then we will address the income approach section of the form. End of page. Chapter start. 92%. Help. Documents. Email instructor. CH17, Small Residential Income Property Appraisal Report. EG2, Learning Objectives for Chapter 17. Notes. Leave a comment. Learning Objectives for Chapter 17. Upon completion of the chapter, the participants will be able to prepare the Sales Comparison Approach section of the 1025 form. Prepare the Income Approach section of the 1025 form. Relate the differences between the 1004 and 1025 appraisal forms. End of page. Chapter start. 92%. Notes. Email instructor. CH17, Small Residential Income Property Appraisal Report. PG3, Chapter 17, Small Residential Income Property Appraisal Report, Form 1025. Notes. Leave a comment. Chapter 17, Small Residential Income Property Appraisal Report, Form 1025. Sales Comparison Approach. Much of the sales grid in the Small Residential Income Property Appraisal Report form, also called the SRIPAR, or Form 1025, looks familiar. Most of the layout is the same as in the URR. We still enter information and make adjustments for such items as location, site, condition, basement, heating/cooling, etc. However, there are important differences in the added sections that require analysis of value indicators on a per unit basis. We are asked to analyze what each comparable sold for per square foot of GBA, unit, room, bedroom. The first three indicators were present in the old SRIPAR, but the last one, price per bedroom, was added in the current version of the form. Remember, gross building area, GBA, according to Fannie Mae, is the total finished area, including any interior common areas, such as stairways and hallways of the improvements based on exterior measurements. Is the most common comparison for 2 to 4 unit properties. Must be consistently developed for the subject property and all comparables used in the appraisal. Must include all finished above grade and below grade living areas, counting all interior common areas such as stairways, hallways, storage rooms, and cannot count exterior common areas, such as open stairways. Let's take an overall look first, and then we can zero in on some key features. End of page. Chapter start. 92%. Help. Documents. Email instructor. CH17, Small Residential Income Property Appraisal Report. PG4, Sales Comparison Approach. Notes. Leave a comment. Sales Comparison Approach. The differences between the URAR and the SRIPAR are outlined in red. This includes the unit indicators, the GRM, and the question on rent controls. End of page. Chapter start. 92%.
Alright, it kind of overlooked the highlighted part. So, it's talking about the Small Residential Income Property Appraisal Report. The highlighted section is talking about proximity to subject, and it shows the subject in all the three comps. The sale price line, the sales price / gross building area, GBA, and you go down, it has dollar per square foot. Gross monthly rent, gross rent multiplier, price per unit, price per room, price per bedroom, and rent control, yes or no, all the way down.